Imagine waking up today, May 30, 2026, and you find the stock market's ultimate fear gauge, the VIX, is just flashing this bright red warning sign.
Yeah, it's definitely a tense morning for anyone watching the charts.
Exactly. And then you look over at gold, which is, the asset everyone historically runs to when they're scared, and it suddenly tumbled 10%.
Right, which breaks all the traditional rules.
It really does. But underneath all of this traditional market panic, hidden from the mainstream headlines, there is this massive, quiet rewiring happening with billions of dollars in dormant crypto assets. So welcome to today's deep dive.
Thanks for having me. It really is a genuinely fascinating moment in the global markets right now. I mean, we are seeing a real-time, high-stakes stress test of where institutional capital actually goes when the old rules of the economy just, stop working.
Yeah, and to figure out how to navigate this, we're cross-referencing traditional technical market data from ONDA and Forex data from MTFX with some incredibly detailed on-chain valuation models on FLR and XRP.
Right, specifically the models from CoinCub and MEXC.
Exactly. And we're also pulling in critical security framework updates from Ledger. So the mission today for this deep dive is to connect the macroeconomic fears of the traditional financial world to the micro-level infrastructure being built right now in the crypto space.
Which is so important whether you manage a massive portfolio or you hold digital assets, or honestly, if you just want to understand the mechanics of global capital flight.
Yeah, exactly. We want to help you break down how to protect your assets in the risk-off world. So let's start with the macro environment, because the traditional safe havens are malfunctioning.
Yeah.
And that is just sucking the liquidity out of everything else.
You really can't understand the micro without the macro here. I mean, the stage for this massive capital flight across all risk assets is basically being set by the volatility index, the VIX.
Right.
Currently, the VIX is holding at this highly critical point of control support zone.
Yeah, looking at the charts, that point of control is sitting right between 22.65 and 23.07. And for those unfamiliar with market profile metrics, a point of control isn't just some random line on a graph, right?
No, not at all.
It's the specific price level where the highest volume of trading has historically taken place. It acts like this gravitational magnet for the market.
And that gravitational pull is exactly what has institutional analysts so on edge right now. Because if the VIX breaks above the 24.0 level, options markets are structured in a way that essentially signals a systemic sell-everything event.
Wow, a sell-everything event for the S&P 500 and the NASDAQ.
Exactly, because when volatility spikes that hard, institutional players are forced by their own internal risk models to scramble and buy put options to hedge their portfolios.
Yeah, they have to protect themselves.
Exactly, but that frantic buying drives the VIX even higher, which creates this incredibly dangerous feedback loop of selling pressure on equities.
It's almost like the VIX is a smoke detector in a giant house, and right now it is just beeping loudly.
That's a great way to look at it.
And usually when that smoke detector goes off, investors immediately grab their trusty fire extinguisher, which historically is gold. You buy gold when equities look dangerous because it's supposed to hold its value.
Right, that's the traditional playbook.
But our ONEA sources show the fire extinguisher is suddenly missing its pin. I mean, gold just suffered a severe bearish breakdown. It dropped a staggering 10%.
Which is a huge move for gold.
Massive. It fell from an intraday high of $4,774 back on May 12, all the way down to $4,368 today. It sliced right below its 200-day moving average.
Yeah, and the mechanics behind why gold is failing as a hedge right now are just crucial to understand. To find the real culprit behind gold's collapse, you have to look over at the bond market.
Specifically, the 10-year U.S. Treasury real yield, right?
Exactly. It just staged a massive bullish breakout, hitting 2.26%.
Let's break down real yield real quick, because that term gets thrown around a lot. We aren't just talking about the nominal interest rate the government pays.
Right, nominal is just the sticker price.
Yeah. Real yield is the actual purchasing power you gain after you subtract inflation expectations. So it's the tangible return for holding U.S. government debt.
And that tangible return changes the entire calculus for asset managers. I mean, gold has a very strong indirect correlation with long-term Treasury yields.
Because gold doesn't pay you anything to hold it.
Exactly. It's a non-yielding asset. It literally just sits in a vault. It doesn't pay a dividend. It doesn't generate interest. So it becomes incredibly unattractive when you can get a guaranteed guaranteed, risk-free 2.26% real return from the U.S. government just for holding a bond.
So in our analogy, those rising 10-year Treasury yields are essentially this guaranteed fireproof bunker.
Yep.
Investors are just dropping the gold fire extinguisher in the hallway and running as fast as they can straight into the Treasury bunker.
That is the exact behavioral shift we are seeing play out. And we also see this liquidity tightening reflected in the Forex markets.
Oh, right, the MTFX data.
Yeah, the MTFX data shows EURUSD is hovering around 1.1659.
Which is a pretty steady 30-day decline.
Exactly. Capital is actively abandoning other currencies and assets to consolidate into the U.S. dollar and U.S. treasuries. It is a textbook flight to safety.
Right.
And it is systematically stripping liquidity out of the broader global financial system.
And when the globe's capital runs into that bunker, it just sucks the oxygen out of the room for everything else, which triggers this brutal ripple effect in the crypto markets.
Oh, absolutely. When liquidity drains from the macro environment, digital assets are usually the very first to get crushed.
Right. And the big money that actually stays in crypto, they rush into Bitcoin for relative safety. And that leaves all the mid-cap altcoins to just bleed out.
And the data on those mid-caps reflects severe market distress. Like, let's examine FLR, the FLR token.
Let's look at that.
We are seeing extreme price fragmentation across different trading venues. On high-volume, centralized spot exchanges, FLR is trading near $0.00098.
Okay.
But if you pull data from specific algorithmic and decentralized Oracle feeds, it is registering significantly lower. I mean, closer to $0.00078.
That is a huge gap. A spread that wide between different data feeds is pretty alarming. Usually, doesn't that mean the order books have become so thin that even a moderate sell order causes massive price slippage?
That's exactly what it means. It reflects a highly illiquid market experiencing total momentum exhaustion.
Wow.
Yeah, the selling pressure is so relentless and the buyers are so scarce that the different data feeds are literally struggling to reach a mathematical consensus on what the actual price of the asset is at any given second.
That's crazy. And the momentum exhaustion indicators are painting a really bleak picture too. FLR's 14-day relative strength index, the RSI, collapsed to this extreme anomaly of 5.65 on May 29.
Single digits.
Yeah, before recovering just a tiny bit to 9.96 today.
And just to put that in perspective for you, an RSI below 30 is traditionally considered oversold.
Right.
Hitting a single-digit RSI is a statistical rarity in any market, period. Behaviorally, a 5.65 RSI means that essentially every single market participant who was susceptible to panic or who needed to liquidate for tax or margin reasons has already sold.
Okay, I hear the behavioral logic there. But looking at these numbers, I actually have to push back a little here.
Sure.
If the entire global market is fleeing to safety, running into that treasury bunker, and we're looking at a crypto token with a single-digit RSI and wildly fragmented pricing, isn't that just catching a falling knife? Like, why should you or I care about a network that, on the surface, looks technically broken?
That is a totally fair question, and that tension you were pointing out is actually the dividing line between algorithmic traders and fundamental researchers right now.
So,
Well, algorithmic, backward-looking models just look at the math of the trend. They see the price dropping, they see the momentum dying, and their kind simply projects that downward trajectory into the future. They just see a falling knife.
makes sense.
But fundamental valuation models, like those detailed reports we have from CoinCub and MEXC, they look at the underlying architectural structure of the network. And what they see is a network transitioning out of an inflationary distribution phase and establishing a hardened base formation.
Oh, I see. So the algorithmic bots are basically just watching the sale price of a house plummet,
Yeah.
while the fundamental models are watching the construction crew pour a massive concrete foundation underneath it.
Exactly. That's a perfect analogy. And that foundation is deeply tied to the broader XRP ecosystem. I mean, XRP is trading around $1.34 right now.
Yeah.
And there are literally billions of dollars of XRP just sitting dormant in wallets and exchange accounts, not generating any yield at all. The market predictions for XRP are deeply polarized too.
Because of that same algorithmic versus fundamental divide.
Exactly. Those same algorithmic models see it potentially dropping below $1 due to all this macro pressure, while the long-term fundamental models project hyper-bullish targets.
Yeah, I saw CoinCub's model in the sources pointing to $29.81 by the year 2040, which they base on eventual institutional utility.
Right. It's all about that long-term utility.
But a crashing price usually forces a decentralized network into a corner, right? Either the project completely dies, or the developers have to fundamentally rewire its underlying economics to survive.
Yes. It's adapt or die.
And that survival mechanism explains how FLR is attempting to weather this massive liquidity drain. So let's get into the mechanics of FIP.16, because it completely changes the math of the entire network.
It really does. FIP.16 is arguably the most critical fundamental shift in the history of the FLR network.
Because of the sell pressure.
Exactly. Historically, FLR has faced constant structural sell pressure by design. The network had these scheduled monthly FLR drops plus high validator emissions.
And when a network is constantly printing and releasing new tokens into a market where liquidity is already drying up, the price has absolutely no choice but to go down.
Right. The circulating supply simply outpaces any organic demand.
It's the equivalent of like a tech startup that just keeps printing new shares and selling them onto the open market just to pay their server bills.
Which never ends well.
Right. Eventually, the existing shares become entirely worthless because the equity pool is so diluted.
Exactly, and that's why FIP.16 is such a game changer. It's a comprehensive tokenomics overhaul that programmatically alters the network's code to stop that dilution.
So how exactly does it do that?
Well, first, it aggressively cuts network inflation down to a flat 3%. But the real architectural shift is the new burn mechanism. The protocol introduces a system designed to burn 300 million tokens annually.
And it does this by capturing network fee revenue, right?
Right.
The mechanics of where those fees come from is what makes this really interesting to me. We aren't just talking about basic transfer fees.
No, it's much deeper than that.
Every time a decentralized application queries data from a FLR oracle or executes a complex smart contract, they pay a fee. Under FIP.16, instead of all those fees just going to validators, a massive portion is corralled by the protocol and permanently destroyed.
Yes. It effectively turns network utility directly into token scarcity. It transitions FLR from an inflation token, which users are incentivized to sell the literal moment they receive it.
Because it's losing value.
Right. It transitions it into a cash flow generating asset powered by a deflationary engine. The more the network's data protocols are utilized by developers, the more fees are generated and the more tokens are burned right out of the circulating supply.
But, I mean, having a great deflationary token means absolutely nothing if it is too difficult for anyone to actually use the network.
That is the million-dollar challenge in crypto.
Right. You can have the greatest stock buyback program in corporate history, but if the customer experience is so terrible that no one buys your product, the company still goes to zero.
Exactly.
So if FLR wants institutional money to generate those burn-triggering fees, they have to hide all the ugly plumbing of crypto. They have to completely remove the technical friction of decentralized finance.
And this is the exact pivot from theoretical tokenomics to tangible infrastructure. FLR is currently building the operational rails to activate all that dormant XRP capital we discussed earlier.
Yeah.
And the first piece of that infrastructure is Facets version 1.3.
Our reports really highlight this as a massive leap forward for user onboarding.
It fundamentally changes the entire user journey. Facets v1.3 simplifies the process of minting FXRP, which is FLR's wrapped smart contract compatible version of XRP.
Right, because previously wrapping a token cross-chain was this highly complex, multi-step process that required users to interact with some pretty intimidating smart contracts.
Yeah, it was a nightmare for regular users. But now it operates seamlessly from a centralized exchange withdrawal.
What?
A user simply initiates a standard withdrawal from, say, Binance or Kraken, sends it to a specific destination tag, and the Facets protocol automatically detects the transfer and mints the wrapped asset on FLR.
So there's no manual bridging. And because they eliminated that technical friction, over 155 million FXRP have already been minted.
Exactly. It removes the bottleneck.
But solving the onboarding friction from centralized exchanges is one thing. The actual decentralized wallet experience is usually where most users just give up.
Oh, definitely.
For those holding native XRP, dealing with EVM, the Ethereum virtual machine style wallets, is usually like learning a completely different cryptographic language.
It's not user-friendly at all.
Managing MetaMask, bridging assets across chains, keeping a tiny amount of a random token just to pay gas fees. That is normally where people either lose their funds making a mistake or they just decide the yield isn't worth the headache.
And this massive barrier is exactly what FLR Smart Accounts, or FSA, is designed to totally obliterate. In the industry, what FSA achieves is often referred to as the holy grail of chain abstraction.
Okay, let's unpack that, because the concept of chain abstraction sounds like pure marketing jargon until you actually see how it functions under the hood.
Right, it sounds a bit buzzwordy.
Yeah. We were basically talking about a user holding a hardware wallet, clicking a single button to sign a transaction on the native XRP ledger, and somehow auto-magically generating yield on a completely different blockchain.
That is exactly it. Through an integration with decent hardware wallets, that is the exact workflow now. An XRP holder never has to download an EVM wallet. They don't have to purchase or hold FLR tokens to pay for network gas fees, and they never have to manually execute a cross-chain bridge.
Wait, really? None of it?
None of it. The user simply signs a cryptographic transaction on their native XRPL device. The FLR Smart Account system detects that specific signature, automatically bridges the XRP, mints the FXRP on the FLR network, covers all the underlying gas fees on behalf of the user, and then deposits the asset directly into an institutional yield protocol.
Like Falconix's Monarch Vault.
Exactly. It takes a terrifying multi-hour technical ordeal and reduces it to a single abstracted click.
That is incredible.
Yeah.
But when you hide all that complex plumbing, the cross-chain bridging and gas fee management, when that's all happening behind the scenes via smart contracts, the user's only actual connection to their money is the piece of hardware in their hand.
Yes.
Which makes endpoint security the single most critical factor in this entire ecosystem.
Absolutely. When smart contracts are doing all the heavy lifting, your self-custody software is your absolute first and last line of defense.
Right.
The security framework documents we have from Ledger really emphasize the vital importance of understanding semantic versioning when you are interacting with these abstracted yield vaults.
Semantic versioning, that's that major minor patch numbering system you see on software updates, right?
Exactly.
Like when your device asks you to install version 2.73.1, most people just blindly click update to make the notification go away.
Guilt as charged sometimes.
Right. But in decentralized finance, knowing what those numbers actually mean literally determines whether your assets are safe.
It does. Semantic versioning is the universal language developers use to communicate risk to the user.
Okay.
The first number, the major version, indicates a massive architectural overhaul to the code. It often includes breaking changes, meaning older applications might just stop working entirely.
Yeah.
Then the second number, the minor version, indicates the addition of new features, like adding support for a new cryptocurrency or a new menu interface. But the core architecture remains stable.
Okay, so if the major update means they basically tore down the walls and rebuilt the house, and the minor update means they just added a new room, that tiny third number, the patch, that must be the one that actually keeps the doors locked and prevents you from getting drained.
That patch number is literally a matter of life and death in crypto security. A change in the patch number means the developers have implemented critical bug fixes or urgent security patches to close a newly discovered vulnerability.
Wow.
Yeah, if you see a patch update for your hardware wallet firmware or your companion app like Ledger Live, you cannot wait until tomorrow. You need to install it immediately.
Because as networks like FLR build out these incredibly complex chain abstractions, relying on automated smart contracts to route millions of dollars, ensuring that your endpoint hardware software is fully patched is really the only way to safely participate.
100%. It's your only shield.
So bringing all of these threads together, it really shows a fascinating divergence in the global markets. I mean, we started by looking at traditional finance, flashing massive systemic warning signs. The VIX is spiking against that critical point of control, threatening a sell-everything event.
Right. Total panic in equities.
And gold, the ultimate historical safe haven, is actively tumbling because capital's fleeing risk and running directly into the 2.26% real yield of the U.S. Treasury bunker.
And then we tracked how that macro capital flight is draining liquidity out of the crypto markets too, devastating the price action of altcoins and pushing momentum indicators like FLR's RSI down into extreme single-digit capitulation territory.
Yeah. But beneath that brutal price action, the fundamental models reveal an infrastructure that is rapidly adapting to survive.
Exactly, building during the crash.
We broke down how FLR is abandoning its inflationary tokenomics through FIPTOT16, creating this deflationary engine that turns network usage into token scarcity. And more importantly, we explored how they are actually driving that usage by building frictionless, hardware-secured infrastructure like facets and FLR smart accounts.
They are building the hidden rails.
Right. The rails that allow dormant capital, like billions of dollars in XRP, to safely generate yield without the traditional nightmare of the decentralized finance user experience.
It is the ultimate example of what institutional analysts mean when they talk about building during a liquidity crunch.
Right.
They are ignoring the short-term price fragmentation and just preparing the architectural infrastructure for the moment the macroeconomic environment inevitably shifts.
Which leaves you, the listener, with a critical final thought to consider. Right now, global capital is aggressively fleeing to the 10-year U.S. Treasury because it offers a safe 2.26% yield in a terrifying market. Right. But macroeconomic cycles are exactly that. They're cycles. They always turn. If those macroeconomic tides shift, inflation cools, and traditional government yields drop back down to near zero, these abstracted, hardware-secured crypto yield vaults will already be fully built. They will be deeply stress tested, and they will be waiting.
Just waiting to absorb that capital.
Exactly. Will institutional money bypass the traditional banking sector entirely to plug their liquidity directly into these automated yield layers? And what happens to the architecture of the global financial system when this boring back-end crypto infrastructure becomes the new safe haven for the world's capital?